Discover the secrets to building massive wealth by permanently lowering your taxes in Tom Wheelwright's groundbreaking book, Tax-Free Wealth. As the founder and CEO of Wealth Ability, Wheelwright is a renowned tax expert who challenges conventional wisdom and reveals how taxes can be transformed into a powerful tool for financial success. Through practical insights and real-life examples, he guides you step by step, teaching you how to leverage the tax code to your advantage and legally minimize your tax burden. With Wheelwright as your trusted guide, unlock the path to financial freedom and take control of your financial destiny. Before we start, don't forget to hit that subscribe button and give this video a like. Your support really helps us create more valuable content for you. Tax-free wealth. How to build massive wealth by permanently lowering your taxes kicks off with an introduction by Robert Kiyosaki, the author of Rich Dad, Poor Dad. He recognizes that death and taxes are the only certainties in life, but if you're smart, you'll do your best to delay both as long as possible. To prolong your lifespan, it's crucial to adopt healthy habits like exercising, eating well, and maintaining overall physical and mental well-being. While it's nearly impossible to completely avoid paying taxes, there are numerous strategies real estate investors can employ to permanently reduce their tax burden. The first step to lowering your taxes is understanding the 4 types of individuals in the cash flow quadrant. They are employee, self-employed, business owner, and investor. Interestingly, employees and self-employed individuals typically pay a higher percentage of taxes, despite earning less compared to business owners or investors. This discrepancy arises from their lack of understanding about the intricacies of the tax game. As mentioned by Kiyosaki in his introduction, taxes are financially burdensome for many individuals. Governments legally collect larger sums from the middle class, encompassing people with incomes ranging from $40,500 to $122,000 per year, as reported by the Pew Research Center. It's important to recognize that tax codes are crafted by local, state, and federal governments to incentivize or discourage certain behaviors. For instance, if your city or town aims to promote workforce housing or urban development, they might introduce tax benefits to encourage real estate investors to invest in affordable housing or inner-city projects. Conversely, if a municipality wants to discourage suburban sprawl, the development process becomes more challenging, expensive, and time-consuming. Rather than resorting to tax evasion, successful real estate investors leverage government incentives and the tax code to their advantage. As highlighted by Tom Wheelwright in his book, you can take advantage of tax breaks through business and rental property deductions without worrying about an IRS agent unexpectedly appearing at your door. The 2 most important rules. Tax-free wealth starts with a quote from Judge Learned Hand, who served on the United States Court of Appeals for the Second Circuit. What Judge Hand said might surprise you because we're often taught to believe that we have an obligation to pay the government. But here's the reality. The tax code is actually designed to help investors and businesspeople legally reduce their tax burden. By not taking advantage of tax breaks, you're essentially cheating yourself, your family, and your financial future. So, let's break it down into 2 simple rules when it comes to tax law. Rule number 1. It's your money, not the government's. Sure, you might have to give a portion of your hard-earned money to the government for things like schools, roads, and defense. But at the end of the day, it's your money, not theirs. Rule number 2. The tax law is primarily written to lower your taxes. According to Tom Wheelwright, about 99.5% of the tax law is aimed at reducing your tax burden. Even though the tax code can seem complex, its main purpose is to minimize your taxes, not increase them. Interestingly, many tax advisors are not aware of these simple rules, and as a result, they end up working for the government rather than helping you reduce your taxes as much as possible. There are 2 reasons for this. First, many tax advisors are actually afraid of the tax law and don't invest the time and effort to learn how to utilize it in your favor. Second, some advisors are scared of making mistakes, so instead of helping you lower your taxes, they focus on protecting themselves. But now that you know these rules, you can be better equipped to navigate the tax system and make sure you're not paying more than your fair share. Entrepreneurs and investors enjoy tax advantages. It's common for the general public to complain about businesspeople receiving unfair tax benefits. In fact, some well-known real estate investors are famous for paying absolutely no taxes despite being multimillionaires. However, when people argue that the tax code isn't fair, they often overlook the fact that nearly anyone in the U.S. has the opportunity to establish a business and take advantage of the various benefits offered by our country's tax system. As explained in Tax-Free Wealth, this is one of the many reasons why investing in real estate is a proven method to generate income, build wealth, and permanently reduce taxes. Let's revisit the cash flow quadrant. They are employee, self-employed, big business owner, and investor. While it's true that business owners, entrepreneurs, and investors pay significantly lower taxes than employees and self-employed individuals, the important question is, why? Tom Wheelwright believes that Congress deliberately structured the tax system to benefit big business owners and investors. Do you remember when Robert Kiyosaki mentioned in the introduction to Tax-Free Wealth that tax laws are designed to encourage specific economic behavior? That's exactly what the tax code does. The government wants business owners and entrepreneurs to create jobs, and real estate investors to provide housing. When you think about it, all the tax breaks granted to real estate investors serve as incentives to promote more housing. This, in turn, benefits local economies by making it easier to attract employers, well-paying jobs, and achieve population growth. Earlier, we mentioned that anyone in the U.S. can start a business. While that's absolutely true, it's important to note that you shouldn't establish a business solely for potential tax benefits. To legitimately receive tax advantages, the business must be genuine and intended to generate profits. Additionally, it is crucial to gain knowledge and education before starting a business. This is because paying taxes is far less costly than experiencing failure in a business venture. The magic of real estate. In this book, you also discover what seasoned real estate investors already know. Real estate is a fantastic tax shelter that can allow you to avoid paying taxes on your cash flow and the profits from property sales. In addition to maximizing deductions to reduce taxable net income, real estate investors have two powerful strategies for lowering taxes and even deferring tax payments. First, depreciation. Depreciation is a deduction that real estate investors can utilize to decrease their taxable net income. It's important to note that depreciation is a non-cash deduction, meaning it doesn't impact your actual cash flow. However, it significantly reduces your tax liability. When you own residential rental property, the IRS allows you to depreciate the buildings and improvements, excluding the land, at a rate of 3.636% per year over a period of 27.5 years. By the end of this period, the property is considered fully depreciated. For example, let's imagine you own a single-family rental property valued at $120,000. Using the depreciation benefit, you can deduct $4,363 from your taxable net income each year. Suppose your rental property generates a net income of $5,000 before depreciation. After deducting for depreciation, your taxable net income would be $637. So, even though you still have $5,000 in cash, your taxable income is only $637. Second, 1031 tax-deferred exchange. When the government offers a tax benefit, they usually expect something in return. If you're not careful, selling your rental property can lead to capital gains tax liability on both the state and federal levels. Let's say you decide to sell the single-family rental property from the previous example after 5 years. You've already depreciated the house by $21,815, setting your tax basis at $98,185. If the property's fair market value has increased to $140,000, you could potentially face a taxable capital gain of $41,815. Effectively, you would be paying taxes on the depreciation recapture along with the appreciation in property value. Fortunately, the IRS provides another tax benefit called a 1031 tax-deferred exchange. This allows real estate investors to defer paying taxes on the capital gain of $41,815 when they purchase a replacement property of similar kind. Not only does this enable you to have more funds available for investment by postponing taxes, but the IRS defines like-kind as any real estate used for business or investment purposes. Many real estate investors leverage a like-kind 1031 tax-deferred exchange to strategically shift their portfolio from one asset class to another, such as selling commercial office or retail properties and investing in single-family rental houses. In conclusion, Tax-Free Wealth by Tom Wheelwright is your ticket to building massive wealth while lowering your taxes. Get your copy of the book and explore the professional investment tool by clicking the links in this video description. Don't forget to subscribe, like, comment, and share this video to join our community of financially empowered individuals. Together, let's create a community of financially empowered individuals who are shaping their own destinies. Thanks for watching.